There's a lot of things going on around us these days, may it be inflation or interest rates or tragic events that are unfolding in Ukraine as we speak. If you're one of those who manages your own money, it does get stressful watching wild swings in the stock market. If history is any guide, macroeconomic and geopolitical news lead to opportunities. If you haven't watched already, check this video out for more detail. If you stay sane and make the right moves, these opportunities can significantly boost your portfolio in the long term. In this video, I want to share one such opportunity that I am personally getting into. Hey guys, thanks for tuning in and welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, crypto, and everything that focuses on building wealth and financial independence. Recent macroeconomic and geopolitical news has created a lot of uncertainty. S&P is in correction while Nasdaq is flirting around a bear market. This has created opportunities. In this video, I'll talk about LEAPS options contracts, walk through an example, and share how I am using LEAPS with leveraged ETFs. You heard that right, options plus leveraged ETFs, which means if we get this right, it has the potential to insanely amplify gains. Let's start with LEAPS. I want to keep this simple, so I'm assuming you understand options. If you don't, watch a video on options basics and then come back to this one. LEAPS, or long-term equity anticipation securities, are options contracts that expire in more than a year. In other words, long-dated contracts where expiration is more than a year out. Personally, anything over 9 months is LEAPS for me. Why would someone want to venture with LEAPS? There are a number of reasons to do LEAPS. In this video, I want to focus on how you can use LEAPS as a stock replacement strategy. Let's take an example. Let's say you are super bullish about Microsoft and you have this feeling that given where we are with stocks, maybe it has bottomed and ready to take off. You want to get 100 stocks, but the damn thing costs $300 a pop, which means you need to shell out 300 times 100 or $30,000. Problem is, you don't have $30,000. Some random dude on YouTube is asking you to consider LEAPS. How does that work? LEAPS allow you to control 100 stocks of Microsoft at a much lower value. Instead of buying 100 stocks outright, you can go with March 2023 280 calls for $4,500. Warning, not every strike price makes sense if your goal is stock replacement. You don't want to go with out of money calls. The question then is, what is the option to support stock replacement? Let's talk entry. Remember, our goal is stock replacement or get same exposure as stocks via options, but with less money. With that goal in mind, there are 3 things you want to consider: expiration date, delta, and liquidity. Of course, this is LEAPS, so per the definition, you want to open positions with expiration date out by at least a year. Personally, I'm fine with an expiration date out by 9 or more months. The most important thing, or Greek, is delta. Delta is the amount of price change an option will see based on the price of the stock. For example, let's assume you have Apple calls with a delta of 0.60 or 60%, and current value of this option is $3. If Apple moves up $1 in any given trading day, the option's value or premium will move up 60% of $1, which is 60 cents, meaning the option value now is $3.60. Simple. Why is this important? higher the delta, slower the rate of decay of options. Decay is loss of value of your contract. Super important when it comes to managing risks. For LEAPS, I suggest you go with a delta of 80% or more, 0.80 or more. This way, you can drastically reduce the impact of decay. If you want to mimic the stock move, you might want to go even higher with a delta close to 1. Every $1 in stock will move the value of contract by $1 as well. We look at some examples and bring all of this together. I promise it will make much more sense. Final point, you only want to deal with liquid contracts or options with decent amount of open interest. The spread between bid and ask price should be narrow and within few cents or dollars depending on the stock. Let's look at some examples. Alright, so I'm going to use Robinhood for this example, but again, these principles apply with any broker that you might be using. Alright, so let's go into Apple and trade options. And because this is LEAPS, you're going to go 1 year out, let's say March 17th. And remember, now you're looking for those criteria like delta and open interest. By the way, anything over the current price of the share, which is 165, give or take, is out of money. Anything under that price is in the money. Simple. All right, let's look at 140 call. Expiring 3/17/23. Okay, the bid-ask spread looks great, open interest looks great, but this is 74 delta. I want something which is 0.80 plus. So this is not the one that I want. Let's look at maybe 130. How about that? The delta here is almost 80. Everything else looks good. Not something that I want to get into. But how about 120? Looks like 120 makes super sense. The bid ask is just perfect and there's a lot of open interest. 16,000 contracts are open, meaning when you go out to sell, you will find somebody who wants to buy your contracts. So you want high open interest. There's a lot of interest in this particular contract. And then the delta is 85, which is just right. So this is what I'm going to go with. Hit buy. And let's say if you were to go with just one contract, that's going to cost you $5,140 as opposed to 100 times 165, which is almost 16,500 if you were to buy 100 stocks of Apple outright. Remember, one contract controls 100 stocks of Apple. So with LEAPS, you can drastically reduce the amount of cash you need to deploy to control 100 stocks, right? Let's take another example. How about we go with something like Microsoft, right? Again, trade options, and we're gonna go March 17th. And in this case, I'm gonna go further down because I wanna go deep in the money. Let's look at 120. Yep, this is another good example. I mean, I would like the bid-ask spread to be a little bit narrow, but given the delta, which is 85, and the open interest, I think this works. Go ahead and buy one stock. Again, one contract, one contract. And that's gonna cost me $8,800. Now, again, this gives you exposure equivalent to 100 stocks. If you were to buy 100 stocks outright of Microsoft, which is trading at approximately $300, that'll be like $30,000. A lot of money compared to $8,820. What you don't want to do, how about we do an example where something you don't want to get into. So I'm going to look at plug, trade options, and go again March 13th. How about we look at 15? Okay, 15 strike, 317. Look at the open interest. Delta is fine, the bid and ask spread is really wide, and open interest is literally nothing. An example you don't want to get into. With LEAPS, you have some time on your side. This allows you to wait for options to work in your favor. Limit order is a classic way to close a position. Have a percentage gain in mind and put in a limit order in advance. For example, sell when gains hit 50%. Here is what I like to do, especially with LEAPS. Typically, I will start a position at 80 to 85% delta. If the stock drops significantly and I'm still bullish, I will add more contracts and bring down my average cost. Remember, we have time on our side, so hopefully it will work in my favor and I will be able to hit my target gains within the next few months. I may decide to close early. Maybe I am at 2 months before expiration. Contract is in the money and delta is still around 80%, and my gains have hit 40% as opposed to 50% target. In such a situation, I may decide to close early, lock some gains, and move on to another position. If I'm still bullish, open another LEAPS call for Microsoft, which is 1 year out. LEAPS work best when markets are down big. Trend is now reversing, and chances are 1 year from now, a market will be up compared to where it is today. For example, right now, where Nasdaq is down huge. Can it go down further? Sure it can. But chances are we will end up higher than where we are today 1 year from now. That's the bet we are making. And with high delta and buying more if it falls, you should be able to effectively manage the downside risk. Next, we are in an uptrend. Markets are cruising and macroeconomic conditions support certain stocks or themes. For example, healthcare and cloud stocks post-COVID. Or maybe it's cash. You want to get exposure to stocks like Tesla and Amazon, but don't want to block a lot of money or don't have that kind of money to buy stocks outright. Go LEAPS. Before I go any further, a warning. I don't recommend leverage ETFs to anyone out there. These are for experienced investors who have the capacity to digest major swings in the market. Moving on. Given where we are with the market, I've opened 2 positions in leverage ETFs, TQQ and SOXL, both expiring January 2023 and are at 80 delta. I opened these 4 days back. Then we experienced the crazy drop when the tragic Ukraine news hit us on Thursday. As planned, I bought some more to reduce my overall cost. It worked out. I will buy more if it falls further. I'm doing LEAPS because I'm running out of cash to buy actual stocks. LEAPS with high delta give me similar exposure as stocks, but with much less money. By the way, I usually try and tweet about major moves I make, so follow me on Twitter or stock tweets if you care. LEAPS are a good way to get similar exposure to stocks with less cash, but it does come with an expiration date. You want to get contracts with 9 months or more to expiration, 80 plus delta, and high open interest. Most of us will close position within a year, so this will be treated as short-term gain from a tax perspective. Also, you don't get dividends as you would with stocks. That's all I have, guys. Go get some LEAPS. If you have any experience with LEAPS, please comment and share your experience. Thanks for watching. Until next time, peace.